According to long-term market cycle analysts, we are due a market correction before returning to the bull trend. Are we in that correction period now? If so, how far into the correction are we? And when and what will trigger that recovery? Welcome to this edition of IG Trading the Markets podcast. We're talking today to Akhil Patel from propertysharemarketeconomics.com. Akhil, welcome. We have caught up with you before talking about these cycles, but the last time we spoke was before this correction and indeed bear market that we're in for some indices at the moment. You were talking then about a possible downturn before the recovery. This has certainly come to pass, but of course, around events that few, if any, were expecting. Before we get to the detail about where we are at the moment, can you return once again to the outline of your cycle analysis and your strategy?
Certainly, Jeremy, and thank you for having me on again. So in broad terms, the overall real estate cycle lasts on average 18 years. It's been going on for well over 200 years in the UK and the US, and for a shorter length of time in other economies. And essentially, it is 14 years up and 4 years down. So 14 years of mostly expansion, 4 years of financial crisis, major crash, and wiping out of debts and saving banks and so on. And that 14-year expansion is itself interrupted by a mid-cycle slowdown roughly halfway through. You tend to get a lot of fear around that time, but the mid-cycle recession tends to be not a full-blown crisis, tends to be a short and sharp recession and then a relatively swift recovery. And as to where we are in that overall 18-year picture, we are sort of 1 or 2 years into the second half of the expansion. And typically that's the much bigger half. And we should expect a peak around 2026.
So now the question is whether or not where we are at the moment is that correction you're talking about. Now, as I said at the top, this has come about rooted in a cause that we really hadn't expected or few had expected. Does it really matter what causes that downturn?
Well, so just to be clear, the mid-cycle recession I was referring to was around the COVID crisis. So recession that took place at the start of 2020, and actually in the case of the US is probably the shortest recession in US history. So I should distinguish between the overall sort of economic real estate cycle, which is 18 years as I've described, and sort of year-to-year fluctuations in the stock market. Now, I think last time I came on the podcast or did a video interview with you, I suggested that actually in 2022, the market outlook was suggesting, at least from a cycles point of view, a correction, possibly the first half of the year, certainly into the middle part of the year. And that would probably set a pretty significant low that might well indeed carry us to the peak that I forecast for the overall real estate cycle in 2026. I didn't think that the potential for who knows how far this conflict between Ukraine and Russia will go. I certainly wasn't necessarily expecting that would be the thing to have triggered the downdraft in the market. But you find as a cycles analyst that actually you can expect something to happen. It happens. You might not necessarily know the cause. In other words, events seem to kind of confirm cycles rather than the other way around. I would say, as a caveat to all of that, I don't know entirely that the US markets have corrected just because of Ukraine. Clearly, it's not helped, and it's created some pretty significant shocks in other indices and also in commodity markets. I think possibly one of the reasons that the correction was pretty significant in recent weeks was the possibility that actually the Federal Reserve might change course, and not knowing what that meant for inflation, which is of course clearly rising in relation to the commodity price changes, and not still emerging out of the coronavirus and all the stimulus that drove some of the inflation that we've been seeing over the last year or so.
So going back in that case, the cycle then, we, as you say, from the peak, we are only down a small percentage, certainly nothing like the COVID lows. As you say, those COVID lows coincided with that recession. We may well see some economies go into recession. We know that Germany went into a period of negative growth going into the back of 2021. Could that continue into 2022? If so, then technically they will be in another recession. But these are two events that are almost outside the normal cycle, aren't they? Because they occurred because of other intervening factors. But it does clear out some of the market positioning. I know when you do see a big move down, and it does enable people to regroup. Um, is this double dip that we've seen over the last couple of years, or if we do go into a further decline now, is this unusual within a 14-year cycle, having two of these heavy pullbacks?
Not really, and actually, I mean, so we've got used to a very long bull market in the 2010s.
Hmm.
I think in sort of historical terms, the corrections that came out of the mid-cycle recession last cycle, which was around 2001, 2002, actually the pullbacks were more significant. And there were, the US markets had a pretty big downdraft in 2001 around the September 11 attacks. They sort of recovered a little bit into 2002, and then there was all this corporate scandals, and it had another pretty major low in October of 2002, if I'm not mistaken, and then a third one at the start of 2003. And in fact, that was the low for European indices. And then we had 4 years of a pretty strong bull market. You could well see, as you get out of the recession, as economies go from, full on recovery mode to something that's a more regular expansion, there's a number of adjustments that need to take place. One is normalization of monetary policy. The second is, concerns about inflation that tend to happen when you get a pretty strong recovery. Yes, you do get pretty significant other events. So again, last cycle we had the run up to the Iraq War in 2002 and 2003, and these do, of course, knock the confidence of investors, and therefore you start to see some pretty, strong market moves. But that is all part of a real estate cycle, an economic cycle, and this isn't the first cycle in history where we've had pretty significant conflicts going on as the backdrop to relatively robust expansions. I'm thinking in particular an event that is also from previous cycle actually quite similar to the ones that we're having now, which was the Cuban Missile Crisis in 1962. So that was in the middle of that real estate cycle. After it finished, we had pretty strong expansion, but during the time it was happening in 1962, there was, some pretty significant market moves. I think there was what's now known as the Kennedy slide in 1962. In fact, that was as much about US politics as it was about the possibility of nuclear war. So all of which to say is that you do have events like this which do knock markets from time to time, but that's all part of the cycle story.
Well, I was going to ask you about this because obviously this particular conflict or war, as I think is probably better to describe it, has the potential to develop in ways we dare not think, as you say, and become possibly a so-called black swan event. So, as an analyst rooted in these cycles, are you suggesting that in the long-term picture, you are, it's the wrong word to say not too worried, because we have to think obviously of the human count of this. And I mean, no one wins out of war, let's face that. And this is a dreadful humanitarian issue as much as anything. But we're here to talk about cycles. So I want to pitch this into this idea that cycles can actually swallow these events that do become black swan events. To what degree does an event like that throw the cycle out, long-term cycle?
Well, in history, the only two things that have knocked the cycle off course, and even in those cases temporarily, were the two world wars. So the UK should have experienced a cycle peak in 1920 or thereabouts. But of course, 1914 to 1918, we were fighting this sort of total war against the Germans. And similarly, there probably should have been a peak around 1944 in the US. And that was knocked back because of the Second World War. Once both of those wars passed, the cycle reasserted itself. Now, if current events, as you say, I mean, they are truly tragic. If they do escalate into something much more significant, such that we're in a sort of major kinetic war with Russia, where NATO is fully mobilized to fighting a war, and of course it may escalate into something even more significant like a nuclear war, then clearly I don't think people are going to be engaging in any sort of form of normal economic activity, and then I would say yes, the cycle will be thrown off. But it will probably take something of that level to knock off the 18-year cycle, because there's so much history behind it, and we've had very significant conflicts over the course of previous cycles, and it's repeated nonetheless.
Okay, well let's round it all back up again then, and assume that common sense prevails around the political tables where talks are being held, and we do get some sort of relatively quick fix to this, and hopefully that enables people to return to some sort of degree of normality within their lives, although goodness only knows how that's going to happen with the amount of damage that's been done. But as I said, that's a matter for another podcast. But assuming we get back to some sort of semblance of what the cycle is prepared to accept in its step, what would you see as we go into the second quarter and the second half of this year? What would you normally expect to see in terms of the cycle recovery?
So normal course of events would be continuation of the rising interest, the planned rate hikes in interest rates. So normalization of monetary policy to the extent that it's not back to where it will be, say, in the run up to 2007, but certainly interest rates will be higher than we've got used to over the last sort of 10 years. You would expect to see a continuation of huge amounts of public investment. That's always accompanies the second half of the cycle. And in fact, in a funny way, this war with Ukraine, or this standoff with Ukraine, if you're talking about it from a point of view of a Western economy, will probably reinforce that tendency, because it's quite clear that governments are thinking much more in terms of defense, spending more on security, spending more on energy security, or on making their economies more resilient. And so some of that public investment, which drives the cycle, the second half of the cycle, I think will be even bigger than it would have been otherwise. And it was already going to be pretty significant. Some of the things that might disrupt markets, but again, plays into the overall cycle, is I think we'll probably be in a period of higher commodity prices. I think supply chains won't work as efficiently as they did before. And indeed, who knows, even if there is some kind of negotiated settlement, how much of Russian and Ukraine commodity exports will be back in the markets, in global markets, in the short term. And so that means that will possibly be a period of relatively prolonged higher commodity prices, which, with each supply shock in different markets, might create a bit of a spike. So there will be some more turbulence, certainly, but higher public investment. And I also think the thing that we haven't talked about yet, and I don't know if I mentioned it last time, is, and this will be a significant difference to the first half of this cycle, is much more bank credit. So we know that regulations have been loosened over the last few years. The banks are very successful at lobbying for that. And they're able to point to a track record that we had the coronavirus crisis, vast swathes of Western economies were shut and banks were okay. We've had this shock in Ukraine, banks have been okay in general, other than the fact that, there was an initial shock when Putin invaded, but I think banks have sort of absorbed that and are starting to recover. And I think they will continue doing what they do best in the second half of the cycle, which is lending for real estate activity, which is highly lucrative and very good for bank earnings, which means bank share prices go up, and also means that the economy is flush with credit. These are all normal factors that accompany the second half of the cycle.
That sounds very, very expensive. And now this is an interesting point actually to make, is that over these cycles, over the last 200 years or so, as a society, we have become more used to higher levels of debt. We have become more used to spending more than we earn. And indeed, we are saddled with enormous amounts of debt now, debt we've never, ever seen before. Does cycle analysis take this into account as well? I mean, you talk about increased public investment. It doesn't matter what it's been spent on, whether it's defense or whether it's basic needs. It is debt. How does the cycle, or how does the market cope with this extra debt? Is there no sort of real sort of concern about that aspect of it when looking at long-term cycle analysis, or is this all part of the calculation about where things go?
Yeah, I mean, this is part of the calculation. So every cycle involves ever increasing amounts of debt. And it's in fact when it goes over the top that brings about the peak. Now you might say, well, we're already over the top, but there's always a bit more to go, and it tends to time. I think what it is, it's when the last person who needs a loan is loaned up, is when it sort of peaks, because there's no sort of further earnings. You're vulnerable. People, particularly people who are borrowing relatively late on, spending the most on property, and because there's been so much debt created that interest rates are rising, and it's quite hard to service debt in relation to income. But banks are only happy to ignore that sort of thing because they want to earn their interest margin and fees on loans and so on. When and this activity is often taking place at the periphery of the economy. So all the people in kind of major cities and major companies have been loaned up, and we're talking about more marginal locations and more marginal companies. When all of that has happened successfully, the economy is much more vulnerable to rising interest rates, and that's what tips the peak into the crash that takes place subsequently. But I don't see us being there yet. What I do actually, and you mentioned public investment. So a lot of this leveling up agenda, which I think is very worthy. I think we're far too London centric in the UK, and so trying to drive investment to other parts of the country is great. But what it does ultimately is support greater land speculation where that public investment is going, and of course bank credit follows that, and so on. And this, for worthy reasons, I think will be the thing that drives, in particular, the second half of the cycle.
That's really interesting. Of course, that does actually bring us back to the beginning, because it takes us back to where you start from, this idea that we're based in property.
Exactly. We all need a piece of land. Either we rent it or we buy it. It's unavoidable, and so that is what drives our overall economy. And you start, actually, interestingly enough, just as an aside, we're starting to see that kind of speculative behavior in virtual real estate. So we're going to take our real estate cycles into the metaverse. I'm convinced. It may not be a story so much for this cycle, but certainly will be for the next one.
Yeah, interesting. It's a fascinating subject. I can't wait to speak to you again later on in the year. Let's hope it's in somewhat better conditions in terms of where we are now, in terms of the prospect for a longer and deeper war. But look, Akhil, thanks indeed for joining us.
Thank you for having me.
Akhil Patel there from Property Share Market Economics. You can catch up with Akhil and his work on propertysharemarketeconomics.com. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.